Okay, now for lesson 66, which is analysing the external environment to assess opportunities and threats, economic change. Right, you've got to have a very, very clear idea in your head, what do we mean by external change? External change is anything that would affect the firm externally. Now, the biggest change is in the world markets, whereby the BRIC countries, Brazil, Russia, India and China, okay, they've been growing really, really quickly at 7 or 8%. Although Russia at this moment in time is doing really, really badly because the price of oil has fallen. So that will have an impact upon firms in the UK. But there's loads of other countries. I mean, Ethiopia is growing at 13%, Korea is growing, Taiwan's growing. There's also mint countries, hopefully get this one right. It's Malaysia, Indonesia, Nigeria and Turkey. Those countries are also growing pretty rapidly as well. So if you're looking at it from a business point of view, is you want to go to those countries which have high growth rates, and it happens to be these areas here. It doesn't happen to be Europe, okay, but Europe is still the biggest market in the world by value at this moment in time. There's 580 million people who live in Europe, so it's still a market that you want to chase. And in the UK we do 50% of our trade with Europe, so even though there's no growth in there, we still do a lot of trade. Now, pretty amazing figures here, and you'll see this in the notes, is that actually every year that world trade increases by 4 or 5% every single year, which is a massive and it's a huge figure. Okay, political, economic, social and technological. Okay, so economic is economic growth, levels of taxation, exchange rates, inflation, fiscal policy and monetary policy. And you need to know what each of these things are. I'm going to go through them in a second or two. We've got social changes, and the only one I can really think of is online changes, and there's a 20% increase year on year in terms of our online usage, which is going to have a massive impact in terms of the retail sector. In terms of other countries, there's a big impact in terms of urbanisation. Okay, in effect, there's a lot of people moving to cities. The cities are now becoming mega cities, and there's maybe 8, 9, 10 million people living in one city. We've also got technological changes, e.g. 3D printing, and because of that there's a lot of reshoring that's going on, or onshoring. Reshoring is when the manufacturing plant moves from maybe Brazil or India or China, moves back to America, and they can produce goods more cheaply there now because their energy prices are falling by 35%, and also they have the right technology, and why not produce the goods in your own country? Therefore the transportation is cheaper. So therefore America's also started to take off. But just as a way of introduction to this subject, I've also got economic growth figures for here and Europe. So right now, and I'm giving this in 2014, it'd be 2015 in a few days' time. The UK economic growth rate is 3%, in Europe it's 0%. Okay, so the UK is doing pretty well. I would say the UK is doing the best in the West. Our inflation rate is pretty low, but there is a fear of deflation in Europe, and a deflation in Europe is a really dangerous thing because it means that there's a lack of demand in your economy. Our exchange rate has fallen, whereas in Europe the exchange rate is too high really for a lot of the southern European countries, Portugal, Ireland, Greece and Spain. They're often called the pigs. Now all those countries, Portugal, Italy, Greece and Spain, all of those, not Ireland, all of those countries at this moment in time are facing massive structural reform and having real problems in terms of getting out of the recession. Fiscal policy is all about decreasing G, is about government spending and taxation, and recently that's gone down in the UK, so therefore we'd expect a fall in aggregate demand. And lastly, you've also got monetary policy on there, which I haven't put on the board here. Monetary policy, you should know that interest rates are 0.5% in the UK, and I think in Europe, actually I don't know what the answer is here. I think in Europe the interest rate may be 0.25%. Now what that means, that's an incredibly low rate of interest. If you've got a really low rate of interest, what that means is hopefully the banks will be lending out more money at low rates of interest. However, there is maybe a slight problem in terms of the UK and its banking sector in terms of not lending money out. And then we've also got free trade on here within the EU. So the UK is free trade with the European Union, and the European Union clearly also has free trade. What does free trade mean? It means there are no barriers to trade. Okay, so analysing the external environment to assess opportunities and threats, economic change. Okay, thank you. This is lesson 66, and a recession will inevitably damage profits in the long term. Yes, well, you have to be very specific in terms of answering the question set. And just because demand goes down, which is what a recession is, 2 negative quarters of economic growth, doesn't necessarily mean that the profits of your firm will fall. For instance, you may decide to cut costs in a recession. So I've got a bit of a cold at the moment. Oh. You may decide to cut costs in a recession. If you cut costs in a recession, what may happen is that even though your demand falls, you may actually save money. Or you may have such a brilliant product, e.g. Jaguar Land Rover, and they decided to enter a new market, which was China. Obviously in that market there was growth, and they're selling loads of cars over there. Or you may decide to have a cost leadership model that does very, very well in a recession because your cost base is lower, so therefore you charge lower price than anyone else, so therefore your company does better. So it is not inevitable, it is not inevitable that a recession will cause a decrease in profits. Okay, there was a big recession in 2008 of -5% GDP in terms of the UK economy. Woolworths went bust, but maybe that was just because of the poor business model. It tried to go in for the online, it was taken up by the online market. Caused Cobra beer did really well, great product, but then the recession came along, it tried to expand too quickly, had a cash flow problem. It was borrowed money from a venture capitalist in 2007 at 33%, tried to expand too quickly, and the company went under. Okay, it's an example of a really good product, really good management team, wrong time. Tesco's out, well, maybe not such a great management team because they eventually were taken over by another company. Then here we've also got Tesco's and Aldi and Lidl. And who would have thought 5 years ago that Tesco's would ever have any trouble? A recession came along, suddenly people were much more concerned about price. Aldi and Lidl, because they have a cost minimization strategy where they have fewer lines than Tesco's. Tesco's has 22,000 lines, Aldi and Lidl only have 10,000 lines. So what happened is their cost base is lower, they have a high price elasticity of demand, so therefore they were able to reduce prices and therefore sell more products, and therefore the company did really, really well. Also, all these companies here, Primark, Ryanair, Domino's. Now, not only have they got low prices, but they've also got pretty good products, so obviously they also did pretty well in recession. And we can show that on here with the high price versus demand, which is when you have a flat demand curve. Sorry, this is the second time I've used this lesson now because I forgot to turn the camera on first time around. But if you have, I'll just draw it again for you, but if you have a flat demand curve and you reduce the price, so price has fallen from P to P dash, on here, quantity's gone up from Q to Q dash, the total revenue's also gone up. So the total revenue was originally this much here, now the total revenue is that much there. Okay, so therefore you can do better. And then we've also got the income elasticity of demand on there, and that shows that maybe incomes will fall in a recession, which they did do in terms of the UK. Between 2008 and 2013, incomes went up by about 1%, but inflation was always higher. So therefore in real terms your income went down. But maybe when your incomes are falling, there may be demand for certain products produced by Primark, Ryanair, Domino's, Aldi, Lidl may well go up. So those products may have a negative income elasticity of demand. Unusual thing to happen. So incomes are falling, but the demand for certain products will go up. But what seems likely is that people have now, because they are slightly poorer, are now much more price aware, and they're really deciding to go to these companies because effectively they may offer the same sort of service as anybody else. Okay, so this is lesson 66. A recession in Europe will inevitably damage profits in the long term. Okay, so we're still on lesson 66, and here we're looking at 4 factors, GDP, which stands for economic growth, taxation, exchange rate, and inflation. Now, in terms of the UK, as I said previously, in the year 2014, the UK is 3% growth, which is okay. But in 2008, we had -5%, and between the years 2008 to 2012, the UK had a very difficult time where growth was pretty much close to 1% or 0%. Right, and obviously the more growth you get, the more demand that you get. But what you must remember when you look at UK growth, this is UK growth. We also need to look at European growth, which is 0% in Europe. In Europe it is 0%, and in the BRIC countries it may well be up to 7 or 8%, and there are other countries now, Ethiopia, that's getting 13%. So overall in the whole world, e.g. for example world trade is expected to grow by 5% this year. So the world picture is looking pretty good. Taxation, well, taxation, the big one here is corporation tax, which has fallen from 28% about 5 or 6 years ago right down to 20%, and it may even continue by the year 2015, which it will be in about four days time. But this figure may continue to fall if there's less corporation tax. That means, which is tax on the firm's profits, there's going to be more investment. Income tax, right, the basic rate of income tax right now is pretty low, of 20%, and the taxation threshold has been raised to £10,000. Some people think that it may go up to 12,000 quid. And there is also the VAT rate has actually gone up, the VAT value added tax, which is 20%, and that will also cause less demand. Right, the next one there is also exchange rates, and exchange rates, if there is a fall in the exchange rate, that means the export prices will fall. And if you have an elastic demand curve, remember doing this previously, an elastic demand curve is a flat demand curve. The price elasticity of demand is more than 1, so if you reduce the price, that leads to a rise in total revenue. Right, but if there is a fall in the exchange rate, import prices will rise. And if import prices rise, we tend to have an inelastic demand for certain goods, particularly for commodities. That may mean that we may spend more on commodities. However, we may start to substitute those sorts of goods like oil for other goods. So you can also do exchange rates with elasticity of demand. Just to prove that, by the way, if £1 was equal to €2, which sets a high exchange rate, if it fell to €1, which it almost did at one stage, that would definitely be a low exchange rate. If we want £1,000 for our goods with a high exchange rate, it's going to cost us €2,000. With a low exchange rate, it's only going to be €1,000. Right, always a good way of analysis there to bring in, there is a fall in the exchange rate, analysis of the price elasticity of demand, etc. And lastly, the last one we're going to do right now is inflation, and inflation is now 1.4%, which is pretty low in terms of the UK. And higher inflation will mean, if we did have high inflation, that would mean we'll become less competitive, because if our inflation rate is 5% and Germany's is 0%, our goods will lose competitiveness against them. And the big thing about inflation is you're likely to raise interest rates. If interest rates go up, that's bad for business, because it's going to cost businesses more to borrow money. Okay, so we've looked here at 4 external factors and how those economic external factors affect UK business. Thank you. Okay, this is lesson 66, and it's pretty damn golden here right now. But right now we're still looking at economic factors or external factors that influence business. And over the last 5 years in monetary policy, we've had a very, very low rate of interest in the UK. Now, in theory, you can therefore say, therefore it's cheaper for firms to borrow money, because the rate of interest is 0.5%, low interest rates, cheaper to borrow money, and if it's cheaper to borrow money, therefore firms will make more investments. However, the key thing here is whether or not banks are willing to lend money out to firms and what rate of interest they charge, because that may be considerably higher. Okay, so monetary policy on here. The next part here is fiscal policy. Fiscal policy is all about government spending and taxation. So it's about G and T. Now, we already know that corporation tax at the moment in the UK is 20% from the year 2015. But one big thing, so taxes in the UK tend to be quite low. The basic rate of tax is 20%. If you earn under £41,000 a year, your first £10,000 is tax free, then the next £10,000 to £41,000 is taxed at 20%. After that, you will then be taxed at 40% between 41,000 and I think it's 150,000. At 150,000, you're then taxed at 45%. Right, so that's one part. So we can basically say the taxation rates in the UK are relatively low, so that's quite good for business. But the other part of this equation is also government spending, and we've had lots of government debt. So therefore most governments in Europe now have cut G, and that's also cut aggregate demand. Now this has been particularly serious in the PIG countries, Portugal, Italy, Greece and Spain. So they've had a fall in AD, and that's actually created a recession. So there's a big issue here that in the UK we want to try and reduce the budget debts and national debts, therefore the government has decreased G. Now actually overall, I think this is really important, particularly in the UK, because our monetary policy has been very loose. That has helped to increase AD by more than the fall in AD caused by the fall in G. Okay, right, lastly, free trade and protectionism very, very quickly in the UK. Because we're in Europe, there's a completely free trade area within Europe, and we do 50% of our trade in Europe, so that's obviously a good thing for the UK, but it also means we import a lot of goods from Europe. Now, but this is what a lot of people now argue. They're saying we should leave Europe because the fast-growing markets are the BRIC countries and also in China. So we should move our trade towards those countries, and we should try and export more to those countries. But there is a tariff on goods going into those markets and a tariff going the other way. One of the big reasons why the UK is successful, though, is the UK is seen as a gateway by foreign firms into Europe. So Nissan, Siemens, DuPont, they all invest in the UK because Europe is a free trade area, so invest money in the UK, which is why we have a lot of those firms. And just a quick point here is the UK now exports more cars than we import, and that's partly because of Jaguar Land Rover, who are owned by Tata, and also Nissan. So this is the argument about free trade, and protectionism is when you put a tariff on a good. So overall I can say here that the conditions right now for British business, because of our low exchange rate, low interest rates, the government is starting to control our national debt, which gives us more confidence that in the UK right now, therefore we have an economic growth rate of 3%. Now this is far higher than Europe, which is an economic growth rate of 0%, so we can say that we're doing okay in terms of the external factors and the economic factors in terms of a business. Thank you.